Energy demand is growing faster than systems can absorb. Energy demand is accelerating faster than generation, transmission, and planning frameworks were designed to absorb. New system level modeling of the eastern U.S. power grid shows that when expected supply fails to materialize during periods of rapid load growth, cost exposure appears quickly, even without reliability failures. Wholesale prices rise, dependence on high-cost resources increases, and volatility spreads across regions and hours. The findings reinforce a broader lesson now relevant well beyond the power sector. When demand growth outpaces supply readiness, markets respond first through cost, not outages, and those signals are already visible. What the latest energy demand modeling is actually showing. A January 2026 modeling analysis from the American Clean Power Association examined what happens when large, expected sources of generation are removed from the system during a decade of projected load growth. The analysis modeled two futures for the Eastern Interconnect, one in which planned resources come online as anticipated, and one in which several under-construction energy projects are indefinitely delayed. The difference between the two scenarios was not abstract. When expected supply was missing, the grid relied more heavily on higher-cost generation, imported power more frequently from neighboring regions, and experienced sustained increases in wholesale electricity prices. When those price effects were translated into retail rates across multiple states, the cumulative additional cost to ratepayers reached tens of billions of dollars over 10 years. The critical insight is not tied to any single technology. It is about system balance. Planning frameworks assumed a certain amount of supply would arrive to meet rising demand. When that assumption broke, the system adjusted through price immediately. Why cost pressure appears before reliability breaks. One of the most consequential takeaways from the modeling is timing. Reliability events tend to dominate public attention, but cost pressure emerges much earlier. As demand grows faster than available supply, the marginal unit of generation shifts toward higher-cost resources. Price volatility increases during peak and shoulder hours. Fuel-constrained assets are dispatched more often. Reserve margins tighten quietly without triggering formal alerts. In the modeled scenarios, these dynamics produce significant cumulative cost increases without assuming widespread outages or emergency conditions. This matters for executive decision-making because it reframes risk. Financial exposure forms before operational failure. Waiting for reliability warnings means absorbing cost impacts that have already compounded. Peak timing, not annual totals, is the real stress point. The modeling also reinforces a pattern grid operators have been flagging for years, but that corporate planning often underweights. Total annual energy consumption is less important than when demand shows up. Price impacts in the supply-constrained scenario were most pronounced. In evening hours, when ramping flexibility is limited. During non-summer periods, often assumed to be lower risk. At times when fast response, high-cost resources must be brought online. This temporal mismatch matters as new forms of demand, data centers, AI inference, electrification of heating and transport, add load that is concentrated, continuous, and difficult to shift. Systems built around smoother, more predictable demand profiles struggle when load becomes both denser and less flexible. Forecasting failure is a governance problem, not a math error. The scenarios modeled were not extreme or speculative. Load forecasts were based on utility and system operator expectations. Resource availability reflected projects already embedded in planning assumptions. The divergence in outcomes emerged because those assumptions were treated as stable. When supply timing changed, but demand trajectories did not, the system absorbed the difference through higher prices, increased imports, and reduced operational margin. That pattern mirrors what many enterprises are now encountering internally. Forecasting models calibrated to historical growth patterns or linear scaling break down when demand accelerates nonlinearly or supply constraints tighten. The result is not immediate failure, but systematic underestimation of cost and risk. Why this matters beyond the power sector. Although the analysis focused on regional electricity markets, the implications extend well beyond utilities and grid operators. For enterprises, energy availability becomes a gating factor for expansion. Price volatility introduces budgeting and contract risk, long-term commitments become exposed to short-term system stress. For technology and digital operations, power and cooling constraints surface after deployment decisions. Energy procurement lags workload growth. Infrastructure limitations shape where and how growth can occur. For policymakers and planners, delay risk matters as much as cancellation risk. Demand growth must be paired with credible, time-aligned supply. Cost signals should be treated as early warnings, not background noise. Across all of these contexts, the lesson is the same. Misalignment between demand growth and supply readiness produces measurable consequences quickly. Cost signals as an early warning system. One of the most valuable aspects of the modeling is what it suggests about how risk should be monitored. Price volatility, increased reliance on peaking resources, and higher import dependence are not just market artifacts. They are indicators that planning assumptions are under strain. When those signals appear, they suggest the system is operating closer to its limits, even if reliability metrics remain nominally intact. Organizations that treat these signals as background noise risk normalizing higher costs as the price of growth. Those that treat them as early warnings have more room to adjust sequencing, investment, and expectations. What decision makers should take from this? The modeling does not argue for a specific policy outcome. It illustrates a structural dynamic that applies wherever demand is rising faster than systems were designed to support. For decision makers, the takeaway is straightforward. Demand growth without aligned supply planning is expensive. Cost exposure appears before reliability crises. Forecast assumptions must be stress-tested against timing risk. Energy demand is no longer a slow-moving variable. As it accelerates, the cost of misalignment compounds faster than many planning frameworks allow. Now is not the time to sit back and wait. Demand growth across the economy is intensifying, from digital infrastructure and AI to electrification and industrial expansion. At the same time, supply additions are increasingly exposed to permitting delays, siting constraints, and execution risk. The modeling shows what happens when those forces diverge. Costs rise first. Flexibility erodes next. Reliability pressure follows later. For organizations making long-horizon decisions today, the signals are already visible. The question is whether planning models will adjust before those costs become embedded. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.